All right, let's get some market analysis. Go big, go broad, go macro, and welcome Kathryn Rooney Vera. She is Chief Market Strategist at StoneX Group. Kathryn, congratulations on the new job, and good to see you in person in New York.
Thank you very much, Scarlett. Happy to be here.
So I have to ask first off about how there's all this uncertainty, and I think the central banks in Canada and Australia added to this sense that policymakers can still surprise the market when they least expect it with these interest rate increases that a lot of people had not anticipated. How does that change the thinking here in the U.S. in terms of what the Fed may or may not do in June and July?
There could be some nasty surprises in the future. Perhaps the next move after a prolonged hold is not a cut, but a resumption of hikes. It all depends, of course, on the trajectory of inflation, specifically service sector inflation. This is a hotly debated topic. A lot of us economists, we economists, we talk about, does it have to do with the labor market? Is NAIRU, the non-accelerated inflation rate of unemployment, is it irrelevant now? I tend to think it is not. So I do suspect that we would have to see a tick up in the unemployment rate to get inflation sustainably down to that 2% target. Now a lot of guys are saying the Fed isn't going to keep the 2% target. They could move it. I've heard you say it.
I believe that.
Yeah. So are they going to move it to 2 or to 3?
Yeah.
What's the new goalpost?
Yeah. What is two-ish to you?
I don't know. I think you need to
two-ish.
find some New Zealand economists to set the new goalpost,
That's
right? Just like the last one.
Two-ish?
I think
Two-ish
it's
is 3?
tricky to change because you lose some of the credibility. The Fed has already lost a significant amount, right? The transitory faux pas, missing.
Now, in fairness, they did put that
targets,
2-ish in there, so they kind
now
of
it's
said
changed
average.
to an average of 2.
Yeah.
But do we get there for the foreseeable future? They don't even think so.
Yeah. What? Go ahead, Scar.
Yeah, I mean, I guess what the Fed is going to say is that they're relying on the totality of the data. What data points are more important now than perhaps before?
Well, actually, what I think could actually sustain this rally, if you will, or help the soft landing case is real wages turning positive. So that tells you that inflation keeps going down. People still have jobs and they're still earning. So they're actually beating inflation in terms of their wage increases. So that's a real positive.
Yeah.
So if we're actually able to land immaculate disinflation, then of course risk assets will continue.
But you remember we were all, I don't know how many months ago, but it seemed like everyone was buying into the soft landing narrative. Then that kind of disappeared. Everyone said that's not possible. Now I feel like there's a lot more discussion now about the proverbial Goldilocks type of scenario, and that maybe the resiliency we're seeing in the economy might actually mean that the Fed can do what they originally wanted to do.
There is always an anchor bias, which we have to be wary of, because economic cycles are precisely that, cyclical. So what is more likely, that the next phase from stagflation, where we are right now, is another expansion, or could it be recession? I'm in the recessionary camp. I do think that we're moving towards that. That's the next phase. Not this year, because unemployment is still too low. Consumption is still very strong.
Right.
Habits of consumption remain as they were in the past because people have jobs.
Right.
It's easy to get one.
Yeah.
You're still getting pay increases. They don't exceed inflation, but you're still getting them.
Right. So recession then, I mean, based on what you just said, that sounds like if we do get towards a recession, does that mean it's going to be relatively shallow, relatively short?
Well, it could be. I think it's probably going to happen towards the back end of 2024, which is the best case scenario for a Fed cutting. I don't see the Fed really cutting until we get either into a recessionary environment, which means a contraction in consumption, whether it be shallow or not. The Fed has to move, I think, when inflation moves lower because consumption is contracting.
Okay, so you're a market strategist. How do you position for all of this? We've talked about all these different hypothetical scenarios. In the meantime, you have to sit here and you're looking at big cap tech stocks. There we go. Continue to build on those gains, except for days like today, and you're missing out on that. What do you do? How do you position?
There's been a big divergence between, for example, small caps and big tech, small caps and the NASDAQ, or the energy and the NASDAQ. I think that can unwind. So I would play the opposite trade that we've seen working up to this point. The other things that I've been recommending, Scarlett, are more, less sexy, but more realistically defensive sectors, staples, utilities, healthcare, and energy. I remain more positive on those than on the aggressive high flyers.
Can I just cherry pick one out of there? Energy. You're confident that that can hold up? I mean, there seems to be a lot of concerns about the supply-demand balances. I'm talking pretty much specifically about oil.
It's a very volatile sector for sure. So your point is well taken. But there is this divergence, as I mentioned, between small cap and energy versus tech, which I think could unwind. So you can play a relative value trade right there.
What about sovereign debt?
Sovereign debt in the U.S. Treasuries, I think, are starting to look interesting. You know, we still like the 2-year, we still like the short end, but the 10-year, I think Bloomberg wrote a nice piece just as I was walking in. I was reading it, how the 10-year, real yield looks like it's going to move positive soon. So one more rate hike, and inflation goes down to 4.1%, and real yields are positive in the 10-year space.
If you had the luxury of being in that building, in the Fed building next week when they meet, what would you advocate for?
I tend to be more of an inflation hawk. I think they need to do their job and get inflation back to 2%. So I would be in the camp of hiking another 25 basis points. I think they should. I think they've gotten it wrong on multiple occasions. There are people that say they're going to hold. They're probably going to hold. They've even kind of insinuated that they would. But then how do you restart later, right? So I would.
Just like Canada, apparently.
Correct. And you started the conversation that way.
I know.
They could hold
Canada shocked us twice this week. One with the rate cut and this one with these fires.
They could hold in July. They could hike at the back end of the year because inflation doesn't come down. There's a lot that can play out.
All right. I mean, it's kind of stunning all the time when people think that they've got the central banks figured out and something else comes along. How concerned are you about the narrowness of the market breadth? Because some people say it doesn't actually signal the market rallies coming to an end, but more that if something changes when it comes to big tech, you could be in for a violent and abrupt shift in price action.
You absolutely could, and if you get a Fed that does resume hikes and goes maybe 2 more hikes, then you have tech come off. I think tech has run pretty far. AI has really supported a lot of speculative, small cap, artificial intelligence names that probably shouldn't be trading where they currently are. So I think there's a level of complacency in the market now. We've talked about waves come and go, market complacency, market pessimism. I think the markets are currently very complacent. We have to take advantage of those opportunities to build up defensive positions for the next phase of the economic cycle.
All right, Kathryn, I'm going to have to leave it there. Great to see you. Great to see you in person. Kathryn Rooney Vera, live from our Bloomberg World Headquarters. She's the Chief Market Strategist over at StoneX Group. One of the great voices we have this hour as we count you down to the close.